Talking about the cost of buying protection.
Tony, I want you to keep it.
Yeah, no, I'm not saying nothing. Not saying nothing. I said my piece.
All right, good. All right. Next, next slide. Okay, I'm going to read to you, and you're going to give me the. You're going to give me the.
Sure.
Okay. With volatility rising into the holiday season and the VIX recently closing above 26, its highest level since April, concerns have grown across the markets. Many bullish traders are considered hedging their long portfolios by purchasing protection. Okay.
Yeah. Yeah, I mean, listen, I think it's an accurate statement.
Since selling calls provides only limited downside defense, many traders turn to stronger hedging methods like buying puts. However, because puts often come with a high price tag, it's worth testing whether this type of protection is truly justified over the long run. I think that's the key sentence here, is over the long run, because I do think occasionally, I mean, guilty as charged, I'll go buy puts if I'm like going on vacation or if I'm not going to look at the markets or if I'm doing something like that. But it's not a consistent thing that I do.
And let's be completely frank here. Like, if you're looking at, and I think they're really looking at here, like more of a classic strategy where you buy stock, sell call. I mean, you sell call for $5. The expected move is $10. It does protect you for 50% of the stock's move. But the stock can go down $20, right? And the call doesn't help you. You know what I mean? Like, or if the stock goes down quickly after you purchase it and sell the call doesn't help you. It has a lot of time factor to it. So a completely accurate statement here.
Well, and I mean, you and I alluded to this earlier today, and I think it is worth talking about again, is the fact that when the vol spikes, your calls aren't doing much for you anyway, because they're not. They're not. If you've sold calls and you get a violent down move and a huge up move in volatility, those calls are not giving you any protection.
That's correct.
Okay, perfect. Next. Oh, there we go. Here's a little chart. Long puts can perform well during market pullbacks. For example, a long SPY 16 delta put could have hedged roughly 4,000 during the correction this past April if the timing was perfect.
Yeah, again, I think they're going to find here that, timing your entry for this is going to be paramount. Not the the strategy itself. Everybody knows if you buy puts and we go down quickly, they work. I mean, especially in the environment that we've had over the last couple of days. If you bought calls and we went straight up, they help a lot. But your timing has to be perfect. And I think retail investors have a very hard time with the timing. I know I do.
Right. And the timing has to be perfect, meaning, but it's only there for, I mean, correct. Retail, it's not something you can always put on. If I was always going to be doing this, I would say cut back your position.
Yeah, exactly. Cut back your buy-in of the stock and the sell of the call, or the strategy that you're using, reduce the size. I would agree with you.
Yeah. I mean, if you're going to consistently hedge it with the same hedge, then just cut back your position. But it's pretty interesting to see. I think these have their time and their place, though.
Yep.
All right. Number 4. Consistently timing market corrections is extremely difficult. Buying puts repeatedly results in poor long-term performances. Okay, good. I'm glad they're monetarily saying what Tony and I actually just said.
Yep.
Okay, so your largest
Nothing to add there.
But that's the largest profit on the put in a down move, right? If you bought the 16 delta put, your largest profit was $5,000 from the put.
That's correct.
Okay.
That's correct.
So nothing to add. Number 5. Most traders won't hold puts until expiration. Taking profits during market downturns can help improve results. In this test, long puts were closed at either a 500% profit target or at 21 DTE. Okay.
Right now, 500 sounds like a lot, but if you're buying a put at 2 and selling it at 10, you know what I mean? Like, where are you? You got to kind of put a number on it.
No, I get it. You have to, they have to give something in order to test it.
Yeah. I mean, you can't say a 50-cent profit. I mean, you're not going to buy something as a hedge to try to, make 50 cents or $1 on it. It really is protection, right? So you got to have some sort of larger number.
But I would like to, I'm glad they did this, because it's only protection if you're willing to close it. Otherwise, you've just wasted the money.
Yeah, well, that's the other quandary. Like, when do you close your quote protection? It's very hard.
Yes. All right, number 6. Managing early does improve performance metrics, but only modestly. Okay, so if you manage early, meaning 500% or 21 days.
Mm-hmm. You look at the success rate, 17%, but you do have that large profit of $4,000 on the overall, like your best case scenario. Your average P&L down $27 is really what you should be looking at here. And then the median P&L, it just doesn't seem to work.
No, no, it doesn't. And this is just the protection, not with the S&P, right? Like it's not
That's
with
correct.
the core.
That's
So
correct.
you're just looking at the hedge.
That's correct.
Number 7. Next, we examine a full married put portfolio, long 100 shares of stock paired with one long 16 delta put.
Okay, this is buying that downside protection that everybody always looks at, right? And always wants to have that outlier move, so to speak, right?
And in this study, were they using 45 days till expiration? Probably, right?
So.
Okay, let's go to the next one. Okay, over the long term, the unmanaged married put underperformed a simple buy and hold SPY portfolio. Well, that tracks. I mean,
well, this is what everybody always says, so why don't I just buy and hold the market as opposed to trying to do anything exotic? And you're right. You probably would do. I mean, you obviously would do better over time here. I mean, we're going back from 2013 up to 2025, and all things being equal here, you really did have a market a position that mirrored the market, just didn't do as well. So you might as well ride out the wave.
You might as well ride out the wave. And that's kind of what I was saying is if you're putting the hedge on, you're just paying for it. Just decrease your portfolio by X amount of percent, because that's the same thing. That's how much.
That's right. You're exactly right.
Yeah.
Right. Buying 100 shares of stock, make it 90 shares of stock or something like that. I'm just throwing out a number.
But I think the Zero-DTEs have changed it, where a lot of people can buy puts for small amounts, or the expirations that are each day for small amounts of money. You can actually buy small amounts.
Sure. Now you're getting into more of I mean, I guess you would call it like a complex option strategy, which is not that complex. Like you're buying front month puts and maybe even selling back month puts against, the stock you have, or if you're looking at it, going from a very short period of time or maybe a news driven period of time. You're picking and choosing though. Like,
that's picking and choosing. If you say, oh, something's going to come out, or I'm worried about it through this announcement, you can, that's become less expensive over the years.
Correct.
Yeah. All right. Number 9, please. Even when managed at 21 DTE or closed at 500% profit target, this hedged position still failed to outperform buy and hold SPY. Management improved results slightly, but not enough to overcome the cost of protection.
I mean, I think it basically says the whole thing here. When you look at the charts, they're almost two, one and the same. I mean, really, what you're talking about is your timing has to be perfect, and even when you time it perfectly, you don't get paid. There are so many other things to do in the market. When you've got volatility that's going from 17% to 23%, and markets that are moving 100 handles a day, 200 intraday, there's so many other things to do than really actually kind of worry about this. So if you really want to be quote unquote long the market, if your friends and neighbors really want to be long the market, you tell them, you know what, you're right. All you really have to do, if you want to participate on the upside, you think the market is going to continue going higher, is buy SPY. It's what we talk about all the time here on the show. You want to participate and mirror the market, buy SPY. You want to get dynamic and have your money use leverage, because most people don't have multi-million-dollar portfolios. They have significantly less. I mean, I think the average portfolio is somewhere around $50,000. You've got to make that act like a $500,000 portfolio, and the only way you can do that is by providing the leverage that trading options allows you to do, and that's what we try to show you on the show.
I agree. And kind of to Dr. Jim's, I'm looking at the SPY markets right now. You can just buy that if that's what you're willing to do, but it's penny wide markets. Yep. There's no gaming in the system. All right, let's see the takeaways.
Yep.
So the takeaways: hedging only works when timed well, which most traders can't do consistently. Agreed. Mm-hmm. Paying for ongoing protection usually hurts long-term performance more than it helps. And then managing long puts actively improves results a bit, but not enough to make the strategy profitable.